Welcome to an introduction to transfer pricing. Today's topic is going to be adjustments, and in particular we're going to talk about adjusting the comparables to have the same accounts payable proportionality as the tested party. So this is adjusting to the tested party. Well, let's look at a different example here, and this example is going to be an adjustment to the comparables to make them comparable to the tested party with regards to the accounts payable level. Now, in a previous video, we've gone through adjusting both the tested party and the comparables to a cash basis, but there's an advantage to adjusting the comparables to the tested party. The primary advantage, as I've mentioned in other videos, is that when your client is looking at their numbers, which is the tested party column, they will recognize them, and they will recognize the operating margin that they've calculated, that they know their numbers. If you make an adjustment to their numbers, their first reaction is trying to reconcile their number to something they thought it was. Makes it harder to explain your results. So in this case, we're going to be adjusting all the comparables to make them more like the tested party. So we're going to start from the same place with the example that we've used in the past. Able, Baker, Charlie, Delta Company are our comparables. Our tested party is the UK Co. And we're just going to talk about their level of accounts payable. For each one of them is different. As you notice, again, Able Company pays cash for everything, so it has no accounts payable. And we're going to state their accounts payable as a percentage of their sales. And this is an important way because we're going to be adjusting each of them as if they had the same proportionality of accounts payable to sales. And we're doing that because our profit level indicator in this case is the operating margin, which is got a denominator of sales. So we're going to make all our adjustments as though they're to sales to keep things proportionate and balanced. So in this case, the adjustment to the tested party is not applicable because we're adjusting everybody to make them like the tested party. So we won't have anything in that particular column, and we've talked in the past about how much the adjustment to the accounts payable would be. In calculating this adjustment, what we're going to do is we need to take into account the time value of money, as we've talked about in the past, the fact that this benefit happens in the future, so we discount it back to a net present value by using the discount rate. And then the key thing we do here is, because we're going to be adjusting the margin, we're going to take the difference in the accounts payable to sales ratio of the tested party versus that of the comparables, and we're going to use that as our calculation. We're going to multiply that times our discount rate. I think the line there says interest rate, but we'll fix that. And then that's going to be an adjustment to the operating profitability that we're going to need to make, which we will then, let's not adjust that too far, adjust the operating profitability. So as you can see here, if we look at some of these firms, again, no adjustment to the tested party. The operating margin for Able Company has gone from what it was before the adjustment at 4% operating margin to now it is only 3.76%. And that's essentially making the following change. It's saying if Able Company, who currently pays cash for everything and therefore gets the rock bottom price, were to now take the same amount of accounts payable that UK Co gets, and UK Co is running about 30 days accounts payable, so it'd be about saying if Able Company were to get a 30 days account payable, they would pay a higher cost of goods sold in acquiring those goods, and that would lower their operating margin. So their operating margin comes down to 3.75. And you can see each of these changes a small amount. Generally speaking, adjustments shouldn't make a huge swing in your comparables. It should make them slightly more reliable, slightly more like your tested party. If there is a huge swing, it's usually best to go back to the comparable and ask, what is it on their particular balance sheet that may be causing this adjustment to be so big? So for example, you might find a comparable that has an extremely large accounts payable, and you might be asking yourself the question, what's going on there? That would be quite atypical. And again, if we take the experiment and we say, let's take the 75th percentile and ask how many multiple is that of the 25th percentile. As you remember, we did this in an earlier video, and this was 333%, or 3 1/3 times. After the adjustments, we can see that if we do the same calculation, taking the 75th percentile and dividing it by the 25th percentile, 316%. So it is a slightly narrower range when looking at it from that perspective. Thank you. I hope you enjoyed this video and all the other videos in this series.